cuties and the 40% of you who have still not subscribed to the Ethicsverse, welcome to the coolest place to be every Thursday at noon Eastern. If you think fixing our workplace can fix our world, we got a real treat for you today. We're going to be talking about you asked for it. We are delivering. We're going to be talking about prediction markets, this next wave of insider trading. There's been a lot of stuff in the news lately about this, and this is something that a lot of us are thinking about. How can we wrap our minds and our policies around this? These markets are totally booming. You can now bet on anything. We were talking the pre-show. You can bet on how many packages FedEx is going to deliver this quarter and anything you can actually imagine. So this is kind of insider trading on steroids, and there's myriad risks coming out. It's kind of living in this gray zone between regulations. And so we're going to be talking about this topic as we get started. Like we say every single week, drop your LinkedIn URL in the chat. If you're not growing your network, I don't know what you're doing. We are part of this really interesting, really collegial community, and you got to take advantage of this thing. And you get no bonus points in life for reinventing the wheel. So your network is your net worth. Neither are big enough. Definitely take advantage of that. We got a lot of cool stuff coming up on the Ethicsverse. I say that every week, and I've never lied. So how do you like that? Next Tuesday, we're going to do an Ethicsverse Healthcare Edition talking about navigating CMS. So if you're healthcare, there's new coding updates and all those kinds of things. So if you're in healthcare, you're going to want to not miss next Tuesday. And then next Thursday, we have risk relationships, rethinking ownership across the enterprise. A couple of other quick announcements as we get started here. We are accredited across all of these organizations. So if you're with HRCI, if you have a certification with SHRM or with the Compliance Certification Board, this is your place to be every week to start stacking those credits. And if you have not won or purchased a copy of Reed Blackman's new book, The Ethical Nightmare Challenge, this thing is flying off the shelves. I've heard so much great stuff about it. I've implemented this in our organization, and it's an absolute game changer. So if you have not gotten this book, you absolutely should. Stay active in the chat. We're going to be giving away 5 of these today. And if you have not downloaded our benchmark report yet, you absolutely should as well. This thing is full of tips and techniques on how you can really gather better risk intelligence and better insights from the data that's contained within your case management system, while at the same time benchmarking your performance from a continuous improvement perspective on what leverage you might need to pull to drive more impact and more value out of this ever important function inside your organization. We have launched Policy Plus. We've gotten hundreds of demonstrations going right now. So if you have some pain points in your policy management process and you are interested in seeing what else is out there, this is a native, an AI native backbone, of course, with all the controls that is going to adhere to any smart AI policy out there. This thing really allows the AI to do a bunch of the work to kind of reduce some of that noise, all the chasing down of policies, organizing all that stuff into one spot so that the humans on your team can make the decisions. And you can have the peace of mind knowing that your stakeholders in your organization actually comprehend your policies. On July 23rd, circle your calendar. I'm telling you, if you loved Ethicsverse Day last year, you're not going to want to miss it this year. We just got news yesterday. One of my all-time heroes, Matt, you are one of my all-time heroes. Another one of them, though. I have a lot of heroes. Another one of my heroes, Dan Ariely, the behavioral science expert who's written so many books that I love, is going to be coming for a session. Behavioral science is look at that. See, I know you guys would love it. Behavioral science is something that we should all be very smart about. We're driving impact in our organization through influence. We're trying to influence behavior. And so we're going to have one of the behavioral science gods on, along with a bunch of other sessions. So if you have not signed up, you absolutely should. We have 4 sessions that day, over 12 credits that we're giving away on the 23rd. And you are absolutely not going to miss it. Or yeah, you're not going to miss it. You're coming. Okay, you got to come. Let's get some emoji explosions going for the one and only Matt Kelly. If you are not following Matt on LinkedIn, you should be able to click his name on the console there and definitely follow him. He's constantly putting out phenomenal articles. And if you have not signed up for his newsletter, you got to go there right now. Control-T or Command-T if you're on a Mac. Open up a new tab and go to Radical Compliance right now and drop your name in the right-hand side. There's a way to sign up for his newsletter. What's great about Matt is that it's never spammy. Everything that he puts out is absolutely phenomenal. And Matt, so enjoy having you on the show. You're one of the all-time greats in my book. Welcome back to the Ethicsverse.
Well, thank you very much, Nick. I always appreciate the kind introduction. I usually get like about 10 or 15 signups every week when you give me a plug like that.
Let's double it. Let's double it today.
We are here today, everybody, to talk about prediction markets and how they are or are not like insider trading, and how companies can start to think that through. And what are the policies you would want to have in place? How are you supposed to find out what employees are doing? What is your liability if they are taking some sort of inside information and doing something inappropriate on PolyMarket or Kalshi or some other prediction market out there? What are the prosecution risks for the people, for companies, for anybody else? What are the regulatory landscape? Spoiler is that it's really quite unclear at the moment. But that's what we are looking to talk about. As always, if you have questions about prediction markets and insider trading, feel free to pop those into the chat as they come to you, or if you have comments, and we will try and weave all of that into our discussion as much as possible. We are having these discussions for the benefit of all of the listeners. So whatever you tell us to worry about, that's what we'll worry about. We have two lawyers joining us to help us think through all of these issues, both of whom have put out legal bulletins and client alerts about prediction markets and the risks that they're posing. One is Jason Hicks, who is a partner at the firm Womble Bond Dickinson. Jason, welcome. Thank you for being there.
Thank you. Thank you for having me.
And also with us is Michael Mann. He is a partner at the law firm Sidley Austin. So, Michael, great to have you here too.
Pleasure to be here. Thanks for having me.
So I'm going to start by throwing out sort of a framing question here that, okay, prediction markets let pretty much anybody bet on pretty much anything, and the employees are pretty much anybody. They could be betting on things they know about your business. So how similar is that to insider trading, even in the first place? Like, the risks here seem to me to be beyond insider trading. It's insider trading plus a lot of other stuff. Is that the right way to think about it? Jason, I'll ask you first, and then Michael and Nick, but how would you describe what the issue is?
Sure. I think that's a good way to frame it. I think it is very similar to insider trading, but definitely different, and it involves new and different risks. I think the first we should think about what is a prediction market, right? So prediction markets are regulated by the CFTC, the Commodities Future Trading Commission. A prediction contract is a contract that is tied to the occurrence of an event. So it pays out if an event occurs. And then those contracts can be traded in the markets, the DCMs, and the value of the contract depends upon the likelihood that the event will occur or not. And these instruments are treated as swaps under the Commodities Exchange Act and regulated by the CFTC. And there's a long history of how we got here, how the agency that's supposed to regulate commodities is now regulating event contracts, which, as you said, can basically allow people to almost bet on anything. But they are regulated by the CFTC. The CFTC has asserted jurisdiction over them, and the risks of insider trading are very similar to traditional insider trading. And there's a provision in the Commodities Exchange Act that's very similar to the SEC rules that prohibits insider trading. There's also a Wire Act provisions and theories of liability under the Wire Act that would be the same, regardless of whether you are using insider information to trade a securities or using it to manipulate a contract on a prediction market, or even engage in traditional sports gambling, which there's been sort of definitely a connection, or some tension between the sports wagering world and the prediction market world. But I'll let Michael speak now to anything else you might have to say.
And I agree that the legal analysis is really not the same as insider trading. Existing sort of insider trading laws really, focused on security statutes and fiduciary duty principles, whereas prediction markets in some ways are focused on, misappropriation of confidential information, confidentiality obligations, fraud, market manipulation, theories that are a little bit different, but I agree they're very similar, but it's a little bit of a different legal framework, but comparable enough that they will look to many as very similar.
And Nick, give me your thoughts here. And like, frankly, I'm kind of wondering how many companies might be caught with their pants down at this moment, because I can imagine there are a lot of listeners thinking, I'm not in the commodities section. I've never thought about CFTC regulation. This isn't us. This isn't my business. And now it's kind of like, well, now it is. And there's going to be a whole lot of new challenges that I think a lot of organizations are not prepared for. But what's your take on it, Nick?
Well, I think that, now every company is kind of a public company from an information standpoint. It used to be that, insider trading required some kind of a security, right? Like it needed to touch some kind of a security. And now like any fact that your company knows before the world does is potentially monetizable. And so I think that really kind of expands the attack surface area, across, just from sort of the finance, department to kind of the whole organization. I don't know. It's from my standpoint, it's kind of insider trading, on steroids, like you said, or maybe like, insider trading without the training wheels. We have, almost 100 years of doctrine and surveillance and like muscle memory, that is built into the security markets that is not really applying, at least right now in the prediction market. So it's kind of like the Wild West right now.
And so I want to sort of walk through a couple of different hypotheticals to understand who actually violated what law. So for example, if I'm the employee and I know the earnings report and I know it's going to be bad, so I go and I sell shares, like that's insider trading. The SEC is going to have a field day with it. And I think people get that. But if I know the earnings release and now I go and I place a bet on PolyMarket, whether the company will meet expectations or not, like I'm still stuck on what law did I violate? Did I violate SEC rules? Did I violate CFTC rules? Did I violate both? Is what I did criminal? Is it civil only? And how are we trying to map some of these potential things you can do onto what the existing law says? But Michael, I'll start with you this time and then maybe Jason. That example, somebody betting on PolyMarket about their company's earnings. Okay, dumb, but exactly what illegal thing did I do?
Right. And so that's a great question. When you think about insider trading traditionally, classical, insider trading is really liability under Section 10 of the Securities Exchange Act, Rule 10b-5, which generally require there to be some type of deception. And there has to, as we've mentioned before, has to be some connection to a sale or purchase of a security. And so if you're trading on stock while in possession of material non-public information about earnings and the like that's insider trading as we've all, experienced before. But in the prediction market context, if a contract pays out because a company is meeting its earning expectations, like that may fall outside, that sort of, concept. But you still have an employee who's monetizing material non-public information. It's just not under, the federal securities laws that we've traditionally seen insider trading. So, that's, where we come into, the CFTC, the Commodity Exchange Act, and certain anti-fraud provisions that are in place to make sure you're not cheating in these certain contracts. And so that's why it's a little bit different. It feels the same as, an SEC, insider trading case that would typically be brought by the SEC. But what you're seeing is a little bit more of the fraud theories or market manipulation theories being, pursued by, the CFTC, which, there's a lot of case law on those issues, maybe not in the PolyMarket, Kalshi world of prediction markets, but there's certainly quite a bit of case law on fraud and market manipulation.
So, Jason, give me your take on this too. Basically, is it that I defrauded the other person on the other end of the bet because I actually knew what I was betting about and he or she did not? Or Did I defraud PolyMarket? Who did what wrong?
Yeah, it probably depends on which theory of liability gets brought. There is a rule in the FTC, in the CFTC regulations, and a provision in the Commodities Exchange Act that mirrors Rule 10b-5 of the SEC. So just because the misuse of non-public information doesn't involve a securities, that may get you off the hook for a securities violation, but it doesn't get you off the hook for a violation of the Commodities Exchange Act and its parallel provisions to Rule 10b-5, which prohibit unfair and deceptive, or that's not the right word. It's misleading, and deceit and fraud involving a commodity and a swap. And here, if you're using it within the information in a prediction market, then you are involved with, manipulating a swap. And so you would have a lot of civil liability under those provisions. There are also Wire Act charges that can be brought for insider trading under the misappropriation theory of insider trading. And there, if you obtain the information through a violation of confidence and then use it, then that can be a violation of the Wire Act. And so it doesn't really there the focus is how you obtain the information and whether there's a violation of duty up front in that respect. It's not a theory of you harmed the person that you were trading against. It's more of a theory that you harmed your employer who you got the information from, or somebody else that you got the information from that you had a duty not to disclose. And then there's also potential for overlapping jurisdiction here. I think there's an SEC chairman or somebody mentioned this possibility that they might consider certain types of prediction market contracts to be securities, even if just because they essentially mirror what a security looks like. And so there's a possibility of overlapping jurisdiction between those two agencies, but regardless, there's definitely liability under the Wire Act.
Well, the reason why I dwell on this so much is try to drill home for listeners the idea that it's all about taking information that I, employee, know and somehow making a quick buck off of what I know before others do. And that suddenly expands the whole realm of businesses that might fall victim to this, like nonprofits never had to worry about insider trading because they're not publicly traded. Well, now you do. Or different types of information. And so I was wondering if maybe we could talk a little bit about the recent indictment of an employee at Google, I think now former, I'm not sure he's been fired, but he was making PolyMarket bets because he already knew who was the most Googled person in 2025. He was a security engineer. He had access to that. But I was thinking, well, who the most Googled person of the year is not material to Google's share price. So this would never be a traditional insider trading thing that moves Google's share prices. And the SEC, I don't know that they'd have anything to do here. But the allegations are that he made more than $1 million because he already knew that it was some singer I've never heard of. But I was wondering if we could walk through the Google case just a little bit. And suddenly I'm thinking, well, what is your duty to keep this information confidential? What about the company's duty to make sure you don't abuse that? And now we suddenly creep more into liability that compliance officers need to think about. I guess maybe, Michael, I'll start with you this time. Like, if you could tell me a little about what's your take on the Google case, and then, Jason, I'd love to hear your thoughts, and Nick's too, about how this expands, like I've said all along, the realm of potential misconduct here.
Yeah, so the Google case is an interesting one. In that case, the former engineer, I think he's a former engineer at this point, he was charged with in a complaint with commodities fraud, wire fraud, money laundering, and that was a parallel complaint from the CFTC and a complaint from the U.S. Attorney's Office in New York City. And so that is influence the outcome sort of scenario, which is actually makes it quite interesting. So you've got an employee here who knows information, in this case, that frankly no one cares about. I mean, this is not like material, not public information that Google's protecting, until they announce it, because it has to do with their financial metrics. It might impact their stock price. This is, arguably, I would call it almost silly information that, but people on prediction markets do care. And I think it's an interesting case because it implicates, potential commodities fraud, potential, criminal fraud statutes, wire fraud, misuse of confidential Google information, for his personal gain. There's breach of fiduciary duty issues, duty of loyalty issues. I'm sure there's, breaches of their codes of conduct and confidentiality agreements that they probably signed there, and other types of, contractual obligations. But I think it's a more difficult case, a little bit for prosecutors to bring because there's no, real value with that information, leaking out into the world and being used to trade on. It's abuse of trust, certainly, for personal financial benefit. And so, it's not, violating insider trading law in sort of the traditional sense, but you are violating a duty to owe to your employer. You are, engaging in fraud, and you're manipulating what's a regulated market. And I think it's going to be an interesting case for, to watch it play out. The criminal case will play out first, to see, how prosecutors do it. But there is some precedent. There was the Chastain case, United States v. Chastain, which was a case that was actually reversed by the Second Circuit Court of Appeals in New York last July. And that was the Chastain case. Was an OpenSea executive was convicted of wire fraud for using confidential OpenSea information about like which NFT collections would be featured on OpenSea's homepage, to trade ahead of their promotion. And so again, it's going to be an interesting case for prosecutors. In that case, the Second Circuit reversed it because there were questions about what the definition of confidential business information was. And I think, we're going to have similar arguments, in the Google case as well. As like, is this really confidential business information? Could this qualify as property under wire fraud statutes, which is a big area of the law? And so it'll be interesting to see how it plays out.
Jason, what's your take on the important things to think about with the Google case? And then Nick, I'd love to hear your thoughts about the headache that this is inducing as well.
Yeah, I agree with everything that Michael said. And I think that I have 2 points to add. One is, the facts of that case are kind of interesting because, and Michael was talking about, what the wire fraud case law and whether information is actually confidential or not. In the Google case, Google kept tabs on who the most Googled person was in the world, and they kept that information confidential. And then there was a big reveal, and there was a planned big reveal, and they were going to announce who the most Googled person was in the world. And so that's why it came about that there was an event contract that was based upon that question. And so the people at Google were supposed to keep that information secret under this theory of the case. And he violated that duty that he owed to Google when he used that information in order to manipulate, or in order to trade on the event contract before that information became public. The second point is, to this phrase that's common in insider trading case law, like material non-public information. I guess the question is material to what, right?
Yeah.
In the insider trading context, for traditional SEC violations, it's material to a share price, right? But with respect to prediction markets, it's really material to what can affect the price of a contract, of a prediction contract. Which is a very different question, and very different types of information can be material to an event contract as opposed to just the share price of a publicly traded company.
And Nick, give me some of your thoughts here. And I just saw somebody in the chat who said, really, this is about the duty the employee owes to the company to keep information private. And I get that conceptually, but like practically, I could see that being a really difficult thing to train and monitor employees and kind of convince them, no, this is for real. Please don't bet on PolyMarket. But like, what do you see as some of the challenges here, Nick?
Yeah, and I don't think that him getting in trouble was, prompted by Google. I think it was from. It's not like Google is suing him for this. You know what I'm saying?
No.
No. There's so Dan Ariely has this, research that talks about how people like cheat most when the link between the act and the money is indirect. And so, somebody betting on the most searched person, it doesn't feel like betraying the employer. And I think that psychological distance and sort of some of the comments in the chat sort of echo this is what is going to allow stuff like this to spread. I mean, it's clearly a sort of gray zone. We're even having trouble kind of pointing to, well, like who harmed who other than, maybe the fair, operation of these markets, which is from a principal perspective, what some of these regulatory bodies are trying to govern. I think, though, if, from a compliance officer's kind of practical perspective, if, the conversation here is, well, this might not technically be legal, or this might technically be legal, something like that. I think that's not probably the message to send. I think the message is broadly to send, or the message to send is broadly one of, overall integrity, and that like, if I'm converting companies' information for my own paycheck, that's not something that we want to, do. You know what I'm saying?
Well, that's kind of where I want to go with this. And we have a couple of people who are picking up on what you had said, Jason, about it can't be material, but, material to whom? And I'm wondering if really what these markets are allowing employees to do is they can create their own material event. We are going to, I'm in charge of the company network and we're going to have a big product launch on Tuesday. I'm going to make a bet on PolyMarket that we're going to whiff that date. And then I crash the network on Monday and I make a killing. But, it's not like when are we going to announce the big product launch? That's not a material thing to the company, but it could be material to me, the engineer, because I'm going to make $1 million too on PolyMarket. Now I'm going to walk off into retirement and go ahead, fire me. Like these are the sort of really difficult situations I think prediction markets kind of open the door to, that employees will take what they know, they're going to monetize it, it'll be material to them, but I don't even know if employers would be able to anticipate all of the ways that employees might try to do mischief here. Jason, what do you think about that theory? And then Michael as well, I'd love to hear what your thoughts are.
Yeah, I mean, I do think there's a risk, and there's a risk for the employer, and they don't want to get caught up in some sort of insider trading investigation or charges, right? And there's potential, we may talk later about what actual liability there is for the company in these types of situations, or whether it's a reputational harm and secondary effects, which can be very large. But the point you raised in your question is, it could impact an employee's performance. Like they could intentionally tank the launch of something in order to gain an advantage in a prediction market trade that they were planning on doing. And that's a very different risk, or it's an even a more severe risk than we might get caught up in this insider trading investigation, because it could have a huge negative impact on the performance of the company itself. And I think, my background is I'm a gaming lawyer, so I tend to think about analogies to gambling laws. And there are lots of examples of folks in sports gambling who have fixed games, and in order to and have worked with people in order to get an advantage in the gambling markets, and that's had negative consequences for obviously their team if they had bet against themselves, but also to Nick's point, a lot of times they justify that because they're saying we're really not hurting the team. we're just I'll just bet on the over. I just bet on the under. Or there's the Cleveland Guardians closing pitcher who was suspended for allegedly working with somebody and betting on whether the first pitch he threw was going to be a ball or a strike. And perhaps he could convince himself that wasn't really, he wasn't violating a duty he owed to his team. Because what did it matter if what one pitch was? And if you could bet on one pitch or not, then, but he was caught and suspended and is now being investigated. The Terry Rozier NBA scandal as well, where he was selling or sharing information about player injuries in order to get an advantage in the gambling markets. And there was no securities involved and and not even a prediction market involved. But he still is facing Wire Act charges under the same type of misappropriation theory that a lot of these insider trading cases involve.
Mm-hmm. And Michael, give me your take on the specter I'm raising here, that employees might, I guess, change what they would normally do because they now have this ability to monetize what they know. This seems like the last thing a company would want to have to worry about. But I mean, how real do you think this potential is, or what sort of legal implications are there if they're making bets on PolyMarket and changing what they do on their job? Like, what's your take on this?
Yeah, I mean, it's a real risk. I mean, it's one of many risks I think that employers have to deal with in this space. But certainly, if you've got employees who are taking steps that could maybe not be in the best interest of the company, that's a real problem. The question is, what I ask employers who are thinking about these issues are, what does your code of conduct say? What are your sort of, how are you communicating to your employees what their, duty are to your employer? And frankly, I like to think that, if you learn some information on the job, you probably shouldn't be placing a bet based on that information. I mean, that's I think is as simple as you could probably put it, right? And then you kind of are avoiding, getting into a question, well, is a single strike or a single ball, making a difference? Well, if you have information from your job, you probably should not be, benefiting from it outside of employer, because you owe a duty to your employer, and your employer expects you to, presumably act in the best interest of the company and all those, fiduciary principles. So, if you're an employee and you're, thinking question, and you're getting this type of information, would I know this information if I didn't have this job here? Am I accessing information through work? It's probably, a problem for those employers. And I think the Google case is actually a really interesting example, because I was talking a moment ago about the Chastain conviction that was overturned. And one of the reasons why the Second Circuit overturned that case is the court there determined that, really whether, an NFT collection was on the front page of OpenSea's website was not really material to that. In Google, I'm concerned for employers who are going to have to really be responsive to the government in these insider trading like cases, because now the government is going out of its way to show, and they do that in those charging documents to address some of the deficiencies in Chastain. And so I think that, going back to why employers should care is it might become quite burdensome for those employers to respond to government inquiries about, well, why does Google's, search of the year matter commercially? Because that's, again, an essential element that the government's going to have to prove if they're going to determine that business information is somehow property for purposes of a wire fraud statute.
I mean, look, if the government wants to find something, they're going to find it. Remember that old Harvey Silverglate book, three felonies a day? Notice what we're talking about here, right? Like that pitcher who threw the ball, he was prosecuted for wire fraud. They can talk about money laundering. Like, if the conduct is wrong, I think the government's going to find a statute. And, if it gets overturned in the second court, then that is what it is. to Michael's point, there's a lot of work and a lot of pain, so to speak, that goes into defending something like that. And that is obviously something that everybody would want to avoid, irrespective of sort of where those clear lines of legality, lie, or if they even exist.
We had a couple of people commenting or asking questions about where states fit into this. So actually, maybe let me pause here and just ask, who is trying to regulate this? Because it seems to me still a lot of what happens on the prediction markets is related to sports betting. So the states are saying, well, no, that's our turf. And I get that the CFTC and the states are fighting over that. But is it right to say while they're fighting over it because of sports betting, all the rest of these prediction market stuff that we've been talking about, like that kind of gets pulled along with the tide? But I don't think the CFTC and the states are arguing over the cases that we're discussing here. They're arguing over who regulates sports betting. But then I don't know, is what the CFTC saying, is that going to stand? Are states going to sue for it? Is somebody else going to sue for it? Are we really just arguing about sports betting? But we compliance officers worried about corporate stuff, we have to wait for that dust to settle, and we get guided by how sports betting is regulated. Jason, since you're the gambling lawyer, let me ask you that first, and then Michael. But what are the battles being fought over who gets to regulate this stuff, and what are they fighting over exactly?
Yeah, it's a very good question. I mean, in some ways, all of this started out in the 1990s when there was a no action letter sent CFTC about the Iowa electronics market, which was just a market by a nonprofit by a university, I believe, that set up for predicting elections. And it was sort of like an academic exercise. And the CFTC said, yeah, you can do that. We're not going to take any action. And then from there, because of changes in the laws allowing for contract markets to self-certify, so they don't have to get prior approval before they put a contract market up. They don't have to seek approval from the CFTC first if they self-certify. And then that and some other changes in the regulations led to a sort of a proliferation of some of these election prediction market contracts. And then the CFTC tried to ban those under the Biden administration and went after Kalshi. Kalshi sued them. Kalshi ended up winning that case. That sort of opened up this whole world of now almost anything can be the subject of a prediction market contract. And that opened up the sports betting or sports-based prediction contracts, as they would call it. And then the states got upset about that because they make a lot of money off of sports gambling, and they're heavily regulated by state agencies and state authorities. And these things, as everybody can see, look a lot like sports betting. And so the states have challenged whether the CFTC has exclusive jurisdiction over this. And there are many lawsuits floating out there about this. There are lawsuits that the states have brought against Kalshi and PolyMarket. There are lawsuits that the CFTC has brought against states saying you can't regulate it. And there's been a mixed outcome on the results of those cases. And sometimes the prediction market side wins, sometimes the state wins. They're working their way up through the appeals court now. They ultimately are probably going to be decided by the Supreme Court at some point. But you're right to say that what they're fighting over mostly are the sports-based prediction markets, not what we are concerned with in this call mostly, but whether the CFTC really has the authority to regulate these, or whether these event contracts are actually illegal gambling under state law. That's a broader question than just sports based event contracts. If the states win, then the result of that, they win on the argument that certain sports-based event contracts are illegal gambling, then that can mean that other types of event contracts are also illegal gambling, even if they don't involve sports.
Well, that's kind of where I'm wondering now is conceivably, could we have, the states win, for example, and now we have prediction market activity regulated by 50 different states, much like data privacy law, and I can already hear compliance officers breathing into paper bags over that prospect. But Michael, what's your take on that? And by the way, is the CFTC going to be able to get away with this when currently one commissioner out of 5, 4 seats are vacant? Seems like a big deal. That shouldn't Congress pass a law about this? But I don't know. But Michael, what's your take on how this could conceivably shake out?
Yeah, no, look, I agree. This is really anything but settled. I mean, the CFTC, without question, has, authority over things like futures, swaps, and other things. But, as noted a few moments ago, a lot of the states have been historically responsible for gambling regulation. And what we're seeing on, some of these markets look, and have a little bit of the feel of gambling. So I think there's going to be, a lot of litigation, particularly for states that feel like they're being, that their, ability to regulate gambling in their state is being infringed on by the CFTC. The fact that you've got just one, commissioner in place, I think effectively they make the calling the shots at the moment, and query whether Congress really even wants to get involved in this, at the moment, given, all the other issues that the Congress is dealing with today. So I think the short answer is, yeah, they're going to, in the short term, the CFT is going to keep pushing forward and has even, taken on and aggressively stepped in. Most recently, I think it was like a week or two ago, they filed a lawsuit in Minnesota that, because effectively, defending their right to ensure that, residents of Minnesota have the ability to participate on these exchanges, which is, a pretty aggressive move for a federal regulator to come in and say, no, you must let the citizens of your state have access to these, private marketplaces. So, it'll be interesting to see how this plays out. And I think, at the moment, the current administration is very supportive of these markets. That might change, if there's a new, in the next administration, it might change. If the control of Congress changes, after November, that might also change if there's more of a push to, what we'll call rein in, what appear to be, conflicts of interest and just questionable activity, on some of these markets that might all, come to a head very quickly. But for the moment, yeah, the CFTC has the ability to do it, and they're doing it.
All right. So let me shift a little bit to how compliance officers listening to all of this should start to think about the policies, the procedures, the controls, the monitoring that they need. Where would they get started with this? But Nick, I'll put it to you first, because I do see a lot of attendees who are kind of saying, we're overcomplicating this. This is about the employee. You have an ethical duty to do right by your company and what we tell you, period. Is that the right way to think about it? Or, how should we try and figure out where to get started?
I think that's right to some degree. What you just said. I mean, we can't really monitor it, right? There was an example in the chat that somebody brought up about this UFC fighter. I think that's a great example of like the trigger for it, or the alert is probably going to come from one of these betting sites due to some like weird activity. So we can't really monitor it. We can sort of debate like where the sort of locus of harm is, whether it's against the company, whether it's material or whatever. I think it's pretty easy just from a gut perspective to, I think everybody would kind of agree that like this is not the kind of behavior we want, our employees to exhibit to kind of enrich themselves with information that's learned within the four walls of the organization. I shared in the chat kind of this little framework that I think is very simple, that can fit on a note card. If you're going to have a policy about it, I would keep it super simple. It's kind of a 3-question test, which I'm just going to read from the chat here. Did I learn this information at work? Is it public? And does the bet's outcome depend on it? If it's a yes, no, yes answer, then they should not engage in that. They're opening themselves up to liability, and they're also opening up the company at least to some kind of reputational risk. And I think, kind of more broadly, look, if you see a guy with a bunch of rings smoking a cigar or talking about his daughter's new pony, and that he hasn't gotten a raise, then perhaps he might be a candidate for a speak up, report about some of these bets, being placed, maybe, from company, from information that he got from the company. So I guess what I'm getting at is like the oldest detection mechanism, to the extent the company quote unquote cares about it, beyond just the commitment to integrity they hope all the stakeholders live out, is going to be somebody speaking up about something. So having kind of a simple policy, at least to roll out to the organization, is maybe a great place to start.
Jason, and then Michael, what would you recommend for how companies build some sort of compliance apparatus for this? And is it policies? Is it training? Do they monitor stuff? But what would you recommend for them? And some of them might already have some insider trading apparatus like that. Can you retool it? What if you don't? You have to build it from scratch. Where do you get started? But anyways, Jason, what would you say first?
Sure. So, I think the easy first step here is, if you already have an insider trading policy and you're concerned enough about insider trading, you should also be concerned about manipulation of information in the prediction market space. So you should make sure that your existing insider trading policy is broad enough that it covers prediction market trades, and maybe even specifically say that it does, so that there is no ambiguity. If you historically have not been concerned about insider trading, then you may have to do a new risk evaluation to see whether you should be concerned about prediction market trading, because as we talked about, the types of information that can be traded on are different when it comes to prediction markets. So the first step might be to go on to Kalshi or PolyMarket and look at the types of contracts that are available to be traded on, and to think, well, does my company have any information that would potentially be relevant to any of these types of events? And that might be a good way to figure out what your risk might be. You may decide that you do, and that you want to create your own policy about prediction market trading and not using company information with respect to that. You may want to update your code of conduct, have a standalone policy. There are many different ways to do that. And I think the answer to the question how you do it is based upon your risk profile.
Okay. Michael, what would you say?
I agree with all that. I think, this is in many ways like a cousin to insider trading. So you want to make sure that you've got, I wholeheartedly agree that even if you have an insider trading policy, you want to specifically talk about prediction markets in there. You don't just assume that the policy is going to, the reader of that policy is going to understand it. The other thing that a lot of companies do, particularly public companies, is there's certifications, there's, different trainings and the like, just to, again, get the message out to the workforce that, this is not acceptable to, trade based on information that you're learning at work. And by the way, some employers might, say, you can't trade on any of this at all that has anything to do with our industry even. Obviously monitoring something like this is very difficult. I do agree though that, and I tell clients all the time, if you don't know what's on there, you got to download it onto your phone just to look, just to understand, mm-hmm. What is going on, what people are actually trading on, and the types of information there. I think, it's not crazy for particularly publicly traded companies or large private companies to monitor to see if there are events that are tied to their businesses, because that might prompt a warning to employees, like, hey, we've seen this market, it has to do with our performance this quarter, or it has to do with whether we're going to announce something on some date, or Google's search term of the year, or whatever it may be, and just use that as a teachable moment to remind employees, hey, you can't go on to these markets and try and make an extra buck by using information that you learned at the office.
Yeah, this is insider trading's cousin that's obsessed with crypto and vaping.
Very much. But let me just see. I'm trying to figure out if there could be circumstances where some liability could trace back to the company. For example, if you have access to sensitive information, well, that assumes the company has some sort of access controls, and not just anyone in the company can go and look up who is the most Googled person. But if you don't have strong access controls, is that Could somebody somewhere, maybe an investor, be unhappy about that? That you got dragged into this fight in the front page of the press, so we're going to sue over that. I don't know. Or if you don't ever bother telling people that we know there are polymarket bets on this, please do not do this. I saw that Kalshi now is going to start requiring some bettors to register where their employer is for some bets. So at that point, the identity of the person is known. So therefore, could the company know that, okay, you're on Kalshi now, you shouldn't be doing that. And if they take no action, do we have any theories of how inaction from the company might translate into liability for them for what their employee has gone and done on one of these bets? Is that possible? Jason, I'll throw it to you first and then Michael.
So we really haven't seen that type of case so far. All the cases that have been brought and charges that have been brought against the individual. Now, there, I believe, regulated entities by the SEC have an obligation to enact certain sort of controls to prevent insider trading. So the regulated entities would have a duty to have some sort of policy and training protocols in place. And public companies might have the similar type of duty under the SEC, but that's with traditional insider trading involving securities. I'm not sure there is a similar framework with respect to prediction market and information that's relevant to the prediction market. There potentially is always sort of aiding and abetting type liability, although that federal criminal law is often extremely broad. So you always have to be careful in saying that there isn't any liability. I think the more serious or realistic threat, though, are the secondary effects of getting caught up in a potential investigation or a charge that your employee has violated the law, and then you have to deal with that, and the serious reputational harm as well. It's serious concern, and it's probably the biggest risk. And like you said, Kalshi is asking for who your employer is before you can trade on their market now. And they have a pretty rigorous compliance program themselves, where they're trying to vet out this type of fraud and misuse on their platform. And so they conduct internal audits and reports that they publicly announce, where they say, we found that this person misused the information on our platform, and they are banned. And so that may be how the issue comes up, even before any government enforcement agency looks into it, and maybe some sort of self-reporting or public audit that Kalshi or PolyMarket does that reveals the wrongdoing.
Yeah, I mean, that's in Kalshi or PolyMarket's best interest to convey to the marketplace that this is a safe place to bet, right? That there's not kind of insider trading and stuff going on, so they can sort of attract more of that, deal flow, so to speak. To your point, I think you're right. The biggest risk is really on the reputational side at the organization. Depending on how public something like that is, that's really where I think the real risk is. It's hard for me, at least based on my current understanding of where these lines of laws sort of lie, how something, how an employee taking advantage of this material, non-public, betting information could really blow back on the organization unless, to your point, it's kind of directed by the organization.
Here's a question from a listener. Michael, maybe I'll put this to you. This is more like just an insider trading, how it works sort of a question, but they're asking, what about wagers placed on companies in similar or adjacent industries, but not my own actual company? I think it's called shadow trading, but that's come up and been prosecuted, right? What is the risk there, or what's the exposure?
I mean, well, it really depends. I mean, what are you trading because you kind of know what goes on in that industry because you've been working in it for the past 10, 15 years and you generally have a sense of how things work? Or are you seeing things that you're learning from your employer about, hey, business is slow right now. Business in the shipping industry, business is slow right now. I know that because, my employer is seeing it every day. And now, competitors, there's a market for a competitor where you could, wager on how they're going to do in the market. So I could easily see, I think it's a little bit safer to be wagering there, but I would again stick with the rules. If you learned it, if information that you are wagering on is information you learned in the office from your employer, you're in a very gray zone, and I would probably be very cautious to be doing too much wagering based on that.
Jason, any other thoughts about that? The shadow trading, because has that ever actually been prosecuted? Somebody bet on somebody else or traded on some other company based on what they knew about their own business, kind of shadowing it or mimicking it?
So I don't know about the traditional insider trading angle there. I would defer to Michael on that question. I do think under the misappropriation theory, under the for mail fraud or wire fraud, it's it's possible, depending on whether a duty was violated in obtaining or using the information that was material to the trade.
All right. Okay. Well, we have just about, I think, 4 or 5 minutes left here. I'll ask each person. I'll ask maybe Michael first, and then Jason, and then Nick. You can wrap it up. Like, how quickly do we need to get in front of this? It seems to me that suddenly this is a very real risk for an awful lot of companies, including companies that have not traditionally had to worry about insider trading. They were nonprofits, universities, they're private, whatever. But it seems like this is a very urgent thing. Where should they get started? What should be the final takeaway? Maybe about 1 minute each from Michael, and then Jason, and then Nick. I'll let you wrap it up.
Thank you.
Sure. Look, I think this is an emerging issue that is something that lots of people are talking about. They're seeing that they're hearing stories. There's a lot of press on it lately. It's something that if you're in the compliance space and you're looking out for risks for your organizations, it's certainly something that you should be escalating and flagging as a question, because updating policies and procedures, updating training, making sure your corporate compliance program is addressing these issues is not a very heavy lift. There's certainly some easy things that can be done, and I think the most important thing that can be done is educating your workforce, making sure they understand what the risks are, making sure they understand how they can get personally in trouble, how the company could have problems and create risks for the organization. And again, not a lot has to. This is kind of tethered to insider trading, so a lot of this stuff has been developed over the years, particularly over the last 10, 15 years in particular, when this is a pretty hot issue. I think it's something that is worthwhile, jumping on and making sure you have a handle on it for your organization.
And then, Jason, if you want to take 60 seconds and give us your parting word of advice, we'd be eager to hear it.
Sure. I think it was Ferris Bueller who said life comes at you fast. It's certainly been the case with respect to prediction markets. Over the last year, 2 years, I mean, it really has exploded. And I would not expect it to die down as quickly. It's not going to go away fast, regardless of who is winning these lawsuits between the states and Kalshi and PolyMarket in courts. They're going to keep those litigation battles are going to keep going. The Supreme Court's probably going to resolve this at some point. That's what most people think. That's not going to be for a while, probably, until the case works up there. And then depending on how it gets resolved, even if the states win, it could be that only sports-based contracts are the ones that are regulated by the states, and the CFTC is still allowed to have a prediction market based upon these more financial and business-related contracts, which are what we're concerned about here. And then also there are offshore prediction market companies as well. So even if this becomes completely illegal somehow and under U.S. law, you probably still have to worry about the issue because the internet is global and there's always folks offshore willing to bend the rules. So there's where there is a market or where there is a desire to bet on something, there's probably going to be a market for it somewhere, somehow.
And there's a VPN that'll get you access to that market. When it comes to prediction markets, I think compliance teams should think about this as a conflict of interest problem. If an employee has a position in a market that is related to your company, it might create a financial incentive for them that goes against their fiduciary duty to that company. So I think this is a potential divided loyalty problem, and it's not really that different than like moonlighting as a competitor, you know? And so from my standpoint, you know, as you can probably imagine, my answer to this is culture. It's probably not another rule. This is something that you can point to kind of describe in, you know, more sort of current details, the type of behavior that your culture of integrity should, you know, produce in stakeholders inside your organization. But I think if people in the organization view information as a shared trust rather than an angle to sort of generate, you know, alpha or some kind of a return for their own pocketbook, then I think you are, you know, you're kind of there. So I would just say to use this, you know, if you want to put something out, use that simple framework that we shared, but use this as a way to kind of reinforce the culture that you're trying to build. So let's get a massive emoji exposure for these guys. This was a very interesting conversation. I've been looking forward to this for a while. And I hope you guys can join us next Tuesday for our special Ethicsverse Healthcare Edition, and next Thursday as well. We got another great one for you. So love you all. See you soon.
Thank you.